As this latest earnings season begins to wrap up, investors continue digesting some of the last reports for the Q2 season, especially those from the retailers. So let's check in now with our research director, Shiraz Mian, to get his read on things as this earnings season winds down. Shiraz, when I last checked midway through the earnings season, the number of companies reporting positive earnings surprises was above recent averages, while the magnitude of those earnings surprises was below recent averages. Is that accurate? And if so, is that a concern?
Yes, it is still accurate, Terry. 79.4% beat EPS. The average over the preceding 20 quarters is 77. So yes, that relationship held steady through now. It's not a concern for me. And the reason for that is that estimates ahead of the start of this reporting cycle had not really fallen that much. So the fact that estimates had not fallen and companies are still able to beat at a proportion that's above average is a positive sign. And I see it net as a positive compared to otherwise.
Also, midway through, the S&P 500 index was reporting its largest year-over-year decline in earnings since Q2 2020. So, in aggregate, what percentage of companies have reported above estimates? What percentage below?
So, as I mentioned, 79.4% are beating EPS estimates. So, that's almost 80%. So 20% are coming up short or coming in line with estimates. That's a pretty impressive showing, given how the estimates, the revisions trend for estimates had unfolded ahead of the start of this earnings season.
And how does that stack up with the rest of your scorecard?
So, for 480 companies that have reported, about 96% of the index as a whole, 8.5% decline, year-over-year decline in earnings for these companies, 0.8% year-over-year growth in revenues. As we mentioned, 79.4% are beating EPS estimates, and 65.4% are beating revenue estimates. The revenue estimates is tracking below what we had seen for these companies in recent quarters. So it's the opposite of what we were seeing with the EPS beats percentages.
What have the standout sectors been?
So it's been broad-based, Terry. Technology, the largest sector in the index, has had impressive results, both in terms of the growth rate, the beats percentages, and also the guidance for the coming periods. Then construction was better than expected, and on the whole, this earnings season has turned out to be better than what most of us feared ahead of the start of this earnings season, and that's shown up in the stock prices and also in the revisions trend for the back half of the year.
Now, as far as the retailers go, it seems like another mixed bag of reports. On the one hand, for example, Target cut its full-year profit outlook. On the other hand, Macy's had an earnings beat, but warned of a continued decline in its credit card sales and a rise in delinquencies. Walmart lifted its full-year forecast. So is that how you would describe it, mixed?
Yes. On the whole, the worry with the retailers ahead of the start of this reporting cycle was that what could be learned about the health of the consumer, about the buying power of households from these results. And we have a full spectrum, as you mentioned, Target, Walmart, Macy's, the home improvement guys, Home Depot, Lowe's. So there's a breadth of different type of spending areas that these retailers cover. On the whole, results are good. You're right. The Target results have been somewhat on the weak side. Walmart much stronger. Macy's has issues with its sales and with its credit card sales. But on the whole, Terry, if we step back from one report to the next and look at the health of the consumer, it still remains pretty strong. And consumers are spending. Companies that have executed on their plans and have the right merchandise in front of consumers are thriving. So Walmart is gaining share in the groceries business. Target, as we all know, has been struggling in the post-COVID world. It has more of a discretionary type of a merchandise compared to Walmart. And those discretionary items are less in demand with consumers who are spending more on leisure and hospitality and things like that. So it is perhaps calling it a mixed bag is accurate, though on the whole, the health of the consumer is good, and companies that have executed well have produced solid numbers as well.
So corporate results from major banks and some airlines seem to bear out what you said. They've confirmed a resilient consumer. Do you see anything from other companies who might be indicating they're looking for a second half consumer slowdown?
Not really. In fact, on the contrary, the commentary from management teams of the companies that don't provide explicit guidance, and then others that do provide explicit guidance, have been talking up what's happening in the economy and the health of the consumer. So we mentioned briefly the tech sector. And tech sector, as you know, has a fair amount of consumer and household exposure as well, though a big chunk is business and enterprise facing. And a number of bellwether companies have actually raised guidance, and we are seeing that in estimates for those companies as well. So the outlook for the back half today is a lot better than what we thought would be the case 3 to 6 months ago.
Against this backdrop, then, what do you see Q2 earnings and revenue growth looking like?
So there's not a whole lot of growth as we have become quite used to. If we combine the 96% reported with the 4% still to come, growth is expected to be down 7.6% for the S&P 500 on the earnings side. And on the revenue side, it is expected to be up 0.9%. Regular readers of our earnings commentary know, Terry, that a big drag on the index in the aggregate has been on the energy sector, whose earnings were down almost 50%. If you take the energy drag out, then earnings in Q2 are down about 1.5%. So not as bad once you take out the energy drag from it.
And on the flip side, what do you see growth looking like for the second half of the year?
So there is another negative, modest negative growth expected in Q3, the current period. And again, that is actually positive when looked at on an ex-energy basis. The current expectation is for a minus 2% decline in earnings. This is expected to be the last quarter of year-over-year earnings decline, and growth resumes. Positive growth resumes from the last quarter of the year. The expectation today is for a 4.4% positive earnings growth in the last quarter of the year, which is actually even higher when looked at on an ex-energy basis. So we are getting to the point when the growth trend inflects from where it had been in recent quarters to a much more positive and reassuring trend line.
All right. Want to remind all of our listeners that they can access your written commentary on earnings, the earnings preview on Mondays, earnings outlooks on Thursdays, right on Zacks.com's homepage. They can view them there and open them up and read them in their entirety. With Shiraz Mian, I'm Terry Ruffalo. Here's something you may want to check out. Zacks is revealing its top stocks priced under $10 per share. Each high-quality company has prospects for 2 times gains or more. Look into them today at Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.